Welcome to Better System Trader, the podcast to help systematic traders of all levels improve their trading. We'll give you loads of expert tips and practical advice on system design and validation, money management, trading psychology, and many other topics. Whether you're just starting out or a savvy systematic trader, we're here to help you improve your trading and find more success. This is Better System Trader with your host, Andrew Swanscott.
Hi there and welcome to Better System Trader. This is episode number 133 and thanks for joining us for this third and final episode in the Mean Reversion series with Cesar Alvarez from Alvarez Quant Trading. We've had a tremendous response to the first two Mean Reversion episodes. There's really been a lot of interest, an incredible amount of interest in what Cesar has shared, and he's really been so generous in sharing that with us as well. In the first episode, we discussed the goal of mean reversion trading, how to select a trading universe, and a number of effective techniques to measuring mean reversion. And we also discussed how to combine indicators to identify better quality trades as well. And then in the second episode, we discussed market classification, ranking trades, exits, order types, position sizing, risk control, and a lot more. And now in this third and final episode, Cesar is going to answer all the questions you submitted for him, covering a wide range of topics, including mean reversion in markets outside of stocks, controlling risk during market sell-offs, gaps, and being overweight in particular sectors. He's also going to discuss the performance of large caps versus small caps and how to rank mean reversion setups. We're also going to have a chat about shorting strategies, readjusting strategy parameters, and measuring robustness. We'll also talk about balancing mean reversion in a portfolio of other trading styles, plus tail risk, leverage, options, performance monitoring, and so much more. So enough of the chit-chat. Let's get straight into this chat with Cesar Alvarez. So we have a lot of questions here, Cesar. I'm just going to start from entries and we'll just work through them and see how we go. So the first question is from Jim. I trade XAU at the end of day only with a very next trading day focus. What mean reversion rule would you recommend using for trading XAU with a very next day trading focus?
So it sounds like what you're looking for is, a one-day hold strategy. For something like that, you're really looking for something that's been stretched quite a bit. I have looked at strategies like that, and what tends to work best are very low 2-period RSI readings, and by very low, I usually mean something like under 1. Those tend to be good for a one-day hold, but you'll have a lot less trades. Another good indicator is actually using Connor's RSI, readings under 5. Both of those tend to set up quite good bounces for a one-day bounce. So that's where I would focus on if you're looking for just a one-day hold. The problem is going to be, the larger the edge that you're looking for, the less frequency of the trade. So there is definitely going to be a trade-off there of, how big of an edge that you want for that one-day hold. And, if your 2-period RSI less than 1 is not producing enough trades, maybe something like 1.5 or 2 will produce enough more trades that you're looking for. But that's definitely where I would go researching for you.
Yeah. Okay. All right. Thank you. Next one is from Tony. Tony would like to know, in order to enhance your entry timing accuracy, do you use any of these structures or levels such as support and resistance, pivots like Floor Trader and Camarilla, or market profile, value area, single print, etc.?
I personally don't use any of those. If those are areas you're interested in and have used in the past with some success, then definitely, as I've covered, using the additional filters, these would be, I think, really good additional filters for you to potentially use. But like I've said, I've not used these mostly because these tend to be a little bit harder to quantify exactly what the support and resistance are. There are some simple ways to do it. But like I said, these are definitely good additional filters that if you like to use, I would definitely look at adding to a strategy as additional filters, as I covered earlier in the interview.
Yep. Okay, I've got an interesting question here from Bobby about ranking. What is the value in ranking orders in backtesting when entering positions using limit entries? Because you cannot know which ones will be filled in live trading. Wouldn't this simply skew the backtesting results when compared to actual trading results?
Yes, you're kind of correct, but you can test. So one thing what you can do is the way I test this using these limit entries, let's pretend I'm trading a maximum of 10 positions I'm currently in 7 positions. So I have 3 open, slots that I can fill. And now let's pretend I have 20 signals for the next day. I don't know which of those 20 are going to trigger. So the idea of ranking is I rank them, and one of my favorite ways of ranking is the 100-day historical volatility. So I rank them. I find the 3 highest stocks with historical volatility, the 3 highest stocks with historical volatility. And those are the trades that I, in a sense, place orders for. And I say, I'll place a 5% lower order than the previous close. And then from looking at the low price of the day, I can tell, well, would it have traded through my limit price? And if so, then I know I would have been entered into that price. That is the way that you can do it. That's short of having actual intraday data, because then you have no idea what order. So if you said, if you were watching the markets during the day, you would know which ones might get triggered, but you don't know which ones got triggered. So you have to do something like a Monte Carlo simulation. And I have a whole blog post, I believe, on about dealing with this particular issue. But you are correct, and you do what I do is I try to do like a synthetic limit order in my back testing, and it works quite well. Results I get in back testing match basically what I get in real life trading, because I do limit entries, and the results. The only time I don't match my back testing is in my back testing. I assume that the low is below my limit price, and sometimes in real life, the low of the day happens to be my limit price, and so I get filled right at the low tick of the day. Which, when I first started trading, I always was happy when it happened, when I got filled the low tick of the day. But then eventually I discovered getting filled the low tick of the day usually was a bad sign that the next day the stock would tank. So that happiness was short-lived.
Yeah. Okay, cool. I'll have to get a link to that blog post from you, and we can put that up on the show notes page as well, so that people can find that easily. Okay. The next question is from Henky. How do you handle situations when a sector sells off and the account gets loaded with similar stocks? The entry conditions might be set so that all the cash is used up the same day, which might lead to higher risk, or that good trades can't be taken in the next couple of days. Do you take this into consideration?
This is a very common question, and this usually comes up for 2 sectors: biotechs and oil. It seems like whenever when I'm trading, or when people have been trading, this is people don't ever want to be overweighted in any of the biotech or oil stocks, it seems like. All the other sectors, nobody seems to complain about. So to answer your question, I have taken this into consideration in the past. So I've done testing, in particular for biotech. Biotech seems to be everybody's, nobody wants to trade biotech because of the volatility in them. So I have done testing where I have removed, or either removed biotechs and just said I won't trade biotech, or I won't take more than 20% of my account, or some percentage of my account in biotech. What it does, short answer is it will reduce your returns. Getting all that heavily concentration, as bad and as risky as it is, does increase your returns. Bad part is, yes, it also increases your volatility, your portfolio. So it becomes a trade-off. Are you willing to take the extra volatility for extra return? I currently, in my own trading, do not have any filter. I will, not happily, but I will place the orders to be, heavily weighted in a sector or not. 90% of the time, it works out beautifully. When you get overly weighted, I'd say, it works out in your favor. About 10% of the time, it's painful, and you get that extra, drawdown because of it. So, but again, and I've mentioned this multiple times, if getting overweighted in a sector would cause you to stop trading your strategy, or cause you to modify your strategy, or to add discretion, then that's when I'd say, you need to put that rule in ahead of time, that you won't get more than 20% or 25%, whatever number it is, into any, those kind of rules that help you to keep trading are more important than, trying to get some extra return, something like that. So yeah, great question. I really should do a blog post on that one, and just showing the results, the difference in the results.
Yeah, so Shashwat asked a similar question about when there's a sudden downturn in the market, but the second part of the question is quite interesting, so I might slot that one in here. It's does mean reversion generally work better in large caps while momentum is stronger in small caps?
No, I'd actually say for small caps in general work better overall, at least recently, at least in my research, in the sense of, I guess, by work better, I mean have higher returns is how we'll define work better. The small caps are just not as followed by as much. You can't have, big quant funds can't be trading small caps that only have a couple 100,000 shares trading a day. So, you have much more individuals in those stocks. So, I have found that trading the small cap stocks have bigger edges, but at the same time, you're dealing with bigger volatility. You get both of them are linked. And then I find this both my breakout strategy and my mean reversion strategies.
Yeah. Okay. Next question is from Jay Adrian. Linda Bradford Rashke did some interesting work with more research some years ago. They found that once a market goes 6 or 7 days under or above a 5-day moving average, then it has a tendency to continue going until around day 15, 16 or 17. And that going with this trend was the most profitable trade, or was the more profitable trade. The problem with mean reversion is that every now and then you do get hit with one of these 6+ day moves and it wipes out the profits for the last dozen or more trades.
Yeah. So, in a sense, you're asking, how can you avoid this particular strategy? And one way to get, the one way, in a sense, I kind of avoid it is when I was talking about using a N-bar exit. So, if I'm in a stock for 7 days in a row and I still haven't had an exit, then I get out. So this keeps you out of situations, where the stock keeps going down and down or barely even moves up. And then you're in it for 15, 16, 17, 20 days, a month or something like that. So that is how, I kind of deal with the continuous, once it's what I call is the rubber band has snapped. Because typically a mean reversion trade, I look as like a rubber band that's gotten pulled and then finally snaps back up. But every now and then that rubber band will snap. And, and that's where I have my, end day exit gets me out of that. And that I just feel for me, it makes me keep trading my strategy because, being in a losing stock, 3 weeks later just is not a fun deal when your typical hold is 5 days or so.
Yeah. Okay, cool. We've got a question here from Bill. It's quite a long question, so I'm just going to paraphrase it. I think we might have addressed some of this in a previous chat, but Bill said in the back testing that he's done, he's found that the results tend to indicate that entering on the close of the day provides more of an edge than entering on the next open because most of their system edge seems to be lost overnight. So are you entering and exiting trades at the close based on end of day charts? And if so, how do you suggest a retail trader go about placing these trades at the close?
So this is another common question I get. And quite honestly, the exiting at the close versus exiting at the open, what works 1 year, it's not a consistent thing. If you look back, you will not see consistently, every year it works better exiting at the close, or every year it works better exiting at the open. Now, if you look over a whole time frame, maybe right now over the last 10 years, on average you would have been exiting at the close better, but it's not one of those things that every year one entry method or entry and exit method works better than the other. I personally do not enter or exit at the close for a couple reasons. First reason is in order for a lot of strategies, you have to be there right at the close. You have to get the data, maybe 15 minutes before the close, and then run your scans and try to place all these orders in the last 5 minutes. Something like that is just prone for error. On some strategies, you may be able to calculate the maybe some values. That says, okay, if, the stock XYZ is above or below some price, then I'm going to get in. But again, all that stuff tends to be problematic. So what will happen often is it will happen where you will get into a stock where then in your back test, it sells off or moves in some direction that says, you shouldn't have been in the trade. Now you have to decide, well, what am I going to do with this trade I'm in that I shouldn't be in because now my back test is going to say I shouldn't have been in this trade. Or the other way, you don't get into a stock that your back test now says you should be into. What are you going to do? So because of those two reasons, now my back test results aren't going to match my actual trading, and I have to decide, well, is it because I just wasn't entering right, or it just adds an extra layer of difficulty for the retail trader. That I think is, if you've got the time to be there, you got a super fast connection, super fast computers, got automated order placement, then it might work for you. But I don't want to be sitting in front of the computer at 5 minutes before the close every day, trying to get everything working and not, God forbid that your internet go down or something else go down and you got the last couple minutes to try to deal with these headaches. Trading is hard enough for me. I don't need additional time pressure of trying to get something done by the clock and worrying about, my data provider or anything else.
Yep. So there's another part to Bill's question here. So Bill says that from his own observation, stocks that have an unusually large gap down in price appear to be less likely to bounce. And they're more often go into a trading range and don't bounce back to the previous range. So at least in the near term. So do you look to exclude buying stocks that have had a recent large gap down in price? And if so, how do you define this condition?
So I'm clear. Were you talking about on intraday a gap down or 2 days ago on a gap down?
I think he's talking about gaps down on the daily chart due to things like profit downgrade announcements, CEO resigning, etc.
You know what? Honestly, I have not looked at anything like that, trying to exclude anything that's gapped down by a certain percentage. It'd be an interesting piece of research to do. I've done it for some other strategies for clients who've had this kind of gap down rule. But in general, for those, it wasn't for a mean reversion strategy, but the gap down rule I found had minimal impact on the results. But again, this wasn't for a mean reversion strategy. Maybe for a mean reversion strategy, it might be good. But I'm sorry, but like I said, I haven't done any real research on that, so I can't give you any insight.
Yep. Okay. All right. Next question is from Sigmund. Does volume play any role in your mean reversion strategies? And if so, how do you use it?
I have tried like crazy to get volume to work. Both of my mean reversion strategies, my breakout strategy, my trend following strategies, I can't get it to work, or I can't get volume to meaningfully add to my returns or anything, or reduce my drawdowns. I know a lot of people really like using volume. I like I said, I've tried quite a bit to get it to work without success. So if anybody's got a trick on how to use volume on mean reversion trading, I'd love to hear it. But it has not been. I've not been able to successfully use or place an indicator or use it as a filter, either to take trades, to exclude trades, not in a meaningful way.
Yep. Okay. All right. The next question is from Curtis, who day trades futures. He'd like your opinion of using VWAP for mean reversion and even breakouts.
So this is going to be a little bit harder to answer because A, I don't trade futures, and B, I don't actually use the VWAP as an entry or exit. I have interactive brokers and I use a TWAP just because I do it over. I always want to just get entries over the first 30 minutes or so. So I can't. I'm sorry, but I can't answer that one in any. I'd just be making stuff up, and I don't like to do that.
Yeah. Okay. Cool. Next one is from Per. Do you recommend building different strategies for different entries, or is it possible in one strategy to combine several entries, like if the RSI 2 is lower than 10 or lowest closing 7 days, then buy?
I tend to do different I'll do like your example there. I will do that. I'll say, that is, to me, that's not a different strategy. That's just having you're looking for two different ways of looking for mean reversion. So something like that I have done in the past. So that is definitely something you can do. It's if you're saying about two different strategies, is when there's really, quite a bit of difference in the rules, then that I don't believe in doing. But if you're just looking at the mean reversion part of that, and then you do something like, okay, the 2 pair RSI is really low and you've got a 7-day lows and close, or 7-day lows and close. That's something like that I think is a good thing to do, especially if you have both of those being really stringent. So I would more likely do it 2 pair RSIs less than 5 or 1. And it's a 20-day closing low, something like that, something that's really sold off. So things that happen less frequently, I would be looking at.
Yeah, and then there's a second part to that question. Do you think that different entries require different exits?
If you're seeing that you have to require different exits, then in my opinion, you really should just separate it out to two different strategies at that point, instead of trying to combine everything in one whole big strategy. It just gets much too complicated. And, I'm always in the simpler is better. So, make it two different strategies. Make sure they will have some overlap, but, make sure you can look at the trade list and you can see, when each one gets in, and if they're not highly correlated, then, that's great.
Yeah. Okay. Next question is from Evan. How do you handle the readjustment of strategy parameters over time? Is it something that you do frequently or ever?
I'll probably look at it every year or two, just more out of curiosity. Here's the problem. The only time people are going to look at something like this, unless you've already got it set, you're going to be looking at it every year or whatever, is when the strategy is not working. And at that point, you're just trying to curve fit to the recent past. So I'll look at it more to see, are the parameters that I happen to be trading just happen to be what I call the bad luck ones. So I will test a range of parameters near the ones I'm trading and say, hey, as a range, have most of them done well, and just the one I picked happens to be doing poorly. Then if I see something like that, then it's like, okay, I'm less concerned about my strategy. But if I see a range of parameters have done poorly, I'm not going to be looking to switch parameters, but more thinking, well, maybe my strategy's gotten out of sync with the market, or maybe whatever edge that my strategy had has been, has been taken out of the market, anymore like that. But I don't do anything, kind of what you're talking about is like walk forward. So I don't do anything like every year. I rerun my optimization and pick the best parameters from that.
Yeah. Okay. And the second question from Evan, how do you handle your single stock exposure in the event that multiple strategies trigger the same stock on the same day?
Because of the way I've built my strategies, that does not happen for me personally. I should rephrase that. It does not happen to me anymore. In the past, I've done it both ways, where I'll take, if I'm getting the signal in two different strategies, I will just double up. And then I've also done it where one strategy takes precedence over the other strategy, just because it has a bigger edge and that strategy gets the trade or not. So I've done it, in a sense, three different ways. Like I said, right now, it's just not even possible for my strategies, I don't think, or theoretically, it has not happened to me in a long time. So that is definitely something to consider, whether you want to take the risk. Normally, I would say you will be better off doubling up.
Yeah. So what kind of things have you done to try and almost guarantee that the strategies don't fire off the same stocks at the same time?
Different universes. So, I have strategies that, trade, S&P 100 stocks, and and that is a one type of mean reversion strategy. I have a second type of mean reversion strategy that trades smaller cap stocks. So those two universes are completely excluded. Then I have another strategy that's a breakout strategy. Well, you can't have a breakout and mean reversion trade at the same time. So, those kind of things. So things like that in my strategies. And then I got another strategy that's trading volatility. So that's a whole different universe. Another strategy is trading ETFs. So I've built my strategies such that the likelihood, of a stock triggering in the same strategy is next to nothing.
Yep. Okay. Awesome. Thanks, Cesar. Now we're moving on to market condition questions. I can't believe all of those questions were about entries, but I think we've exhausted that. So the first question about market conditions is from Emil, I think it is. What kind of strategies work in your experience in a low volatility market regime like we're having now?
Yeah. I mean, mean reversion will still sort of work now. The problem with mean reversion now is the edges. You're just making so little off the mean reversion trades. But what I've definitely discovered is the breakouts tend to be working, for me, have been working quite well this year in this low volatility environment we've been in. I don't know, this breakout strategy I've been trading, I have not traded in previous low volatility environments, so I don't know if it's something particular to this one. But the strategy that's definitely working the best for me is my breakout strategy that I'm doing.
Yeah. Okay, next question is from John. When building a mean reversion individual stock strategy, what role have you found the price action of the overall market index plays when filtering good quality mean reversion signals in a stock to index correlation capacity?
Let me think this one through a little bit. So I mean, what I find the overall market filter does for me is I wouldn't say it's the quality of the mean reversion, but more the reduction in the volatility of the strategy. So, I mean, mean reversion trades when the market is underneath the 200-day moving average still work, and they tend to be quite profitable. But your losers tend to be quite painful too. So that is why I personally have my market filter in. Not sure if that's completely answering your question, but that is how I use the market filter for my own trading.
Yep. And a question from Joseph. Now, we did already cover a number of techniques that you like to use to measure market conditions. Joseph would like to know if you have a favorite one that helps you deem if a market is suitable for mean reversion versus trend following.
So that is actually a different question. And it's like something I've been thinking about lately, of trying to develop an indicator, or just some way of determining, is a current market better for mean reversion versus my trend following strategies. I don't have anything right now. Funny you should ask that, because before this call here, I was out on a walk thinking about this exact thing on different ways of how to measure this. I've got a couple of ideas that I got to try out, and hopefully they will work out. And if so, I will definitely write about them. But it is something that's definitely at the top of my research list.
Yep. And now let's move on to exits for a little bit. Craig's got an interesting question here. I find with trend following approaches, I tend to use a particular style of exit method to maximize the winners, giving the natural positive skewness of its return distribution. I've heard a number of times that mean reversion has a more negative skew. Do you find that you use a particular or favorite style of exit with mean reversion? And if so, what is it?
I haven't found an exit that changes that negative skew on mean reversion. That's just part of the mean reversion strategies. There is no particular exit other than waiting for that bounce. A trading friend of mine, we used to have this phrase, we're just looking for any excuse to sell a mean reversion trade. And that excuse is it's had a bounce. Hopefully it's had a big bounce. But as for anything in particular, for the mean reversion, I'm still, the 2-period RSI over 50 or 70, those tend to work well, or even a cross back over the 5-period moving average. Those tend to be my favorite mean reversion type of exits. Quite simple, nothing, but it won't solve the negative skew of your trades.
Mm. All right, we've got a couple of questions here from Robert on exits. Now, as far as I can see, all of these were covered in our exit chat. I mean, these questions were posted before that. So, Robert, go and have a listen to that one, and all the answers to these questions are in that one. So the next question is from Evan. What steps do you put in place in order to protect against the tail risks that are often associated with mean reversion strategies?
You can't. That's the simple answer. The tail risk in mean reversion usually happens overnight. I don't think I've ever been in a mean reversion trade that went down 50% one day at a time. Any mean reversion trade that I've been in that's gone down 50% has happened overnight. And there's nothing you can do about an overnight tail risk on a stock like that. I mean, yeah, I guess you could say, well, let me play options and try to protect yourself that way, but you'll just kill all your edges. That is, actually, it's the danger of trading any stock strategy is these, overnight tail risks. And there's nothing you can do about it. Like I mentioned earlier in one of the interviews, what you have to be able to do is, you have to look at your position sizing and say, if this stock opened down 50%, could I keep trading? If the answer is no, then your position sizing is too big. Because I can guarantee you, unless you're trading something like S&P 100 stocks, if you're trading Russell 3000 stocks or smaller cap stocks, it will happen to you sooner rather than later that, some stocks are going to open down 50%.
Yeah. Okay, cool. Thanks. Now, we've had a number of questions about other markets. They're all very similar. We've had Robert, Luis, J. Adrian, Giuseppe Per, and a couple of others ask about the application of mean reversion in other markets, futures markets, ETFs, that kind of thing. So what can you share? Have you done any research into these kind of things? Can you share some insights into other markets?
Unfortunately, I've tried a little bit in the, a little bit of testing in the futures markets, and I found, there's some definitely mean reversions working there. I've very briefly in currencies a long time ago. I really couldn't find anything there. Again, I wouldn't say I've done deep research in those two markets. So take what I just said with a very large grain of salt. ETFs, those, mean reversion works great on the ETFs. So that's definitely, but those are still in a sense stocks in one point of view because they're built off stocks. But as for the other markets I have, like I said, for futures, there's definitely seems to be a mean reversion component there. Currencies less so, but again, not spent a lot of time researching those.
And what's your views on the use of leveraged products with these strategies as opposed to straight buying and selling of stocks?
What do you mean? What do they mean by leveraged products?
I think maybe could they be talking about leveraged ETFs, perhaps?
Yeah. So I mean, if you're talking like a leveraged ETF, your mean reversion is going to work great on those. I used to have a strategy that did decently well with that. Problem is your volatility is way up there, and that's the harder part that I had to dealing with. And eventually, was part of why I stopped trading that strategy. Was the volatility was a little bit more than I could handle.
Have you done any testing selling option premium in your work, and how did it work out?
I have not done any of that, but I know a couple of traders that have successfully done something like that using mean reversion, but I can't give you any details on that. Like I said, I don't trade options, but a couple of friends of mine do, and I believe that's one of the ways that they trade the mean reversion trades.
Okay, so let's move on to shorting. We had quite a few questions about shorting as well. A lot of people would like to know more about shorting. So do you trade short with mean reversion?
So I used to trade short with mean reversion. Mean reversion works great on the short side. You can't just invert your rules, but conceptually it's still a mean reversion trade. The hard part is the reason I don't short is a couple of reasons. One is every now and then shorts can go up 100% quite easily. I have been in several trades where I was short and the next day the stock gaps up 100%. I've never been in a long trade where the stock gaps down to zero. So that psychologically is really hard to deal with, and you lose several months of profits when that happens. So that is one reason why I don't short. That's probably the main reason. The second reason is in back testing, you can't take into account whether a stock was available to short or not. So what ends up happening is it's hard to match, your back tested results and your real life trading results never quite match. And it's often because you couldn't short something, and it's hard to understand, well, is my strategy not working because of execution or things like that. But the biggest reason I don't short is just dealing with those 100% plus gap ups, because your edges are going to be, again, on those smaller stocks. And those charts, man, when you go into shorting those, they're just like rockets going up going up, and they're hard to pull the trigger. But if you have the stomach for it, I believe shorting is still where there's a great edge on the mean reversion side.
Yeah, so if someone did have the stomach to do short trades, how would you recommend they go about developing strategies? Would they use a similar kind of logic, or is there different parameter sets and different considerations you need to make for that, the difference in behavior there?
Right. So, like I said, you can't just simply invert the rules. What you have to do is, from a long system, you have to invert the rules and exaggerate them. So if you were saying, okay, 2-period RSI less than 10, you wouldn't just say 2-period RSI greater than 90. No, you have to say 2-period RSI greater than 99, and it's been above it for 3 days or something like that. It's instead of saying it's stretched 5% below the 5-period moving average, it's stretched 10% above the 5-period moving average for 3 days or 4 days, something like this. You're looking for a much more exaggerated stretch on the short side, and and then usually then I found another good little tidbit is this is where having an intraday profit target also seemed to work quite well on the strategy I used to be trading. So some of the things that don't apply on the long side now suddenly apply on the short side.
Yeah. Okay, awesome. And I think perhaps it was in the first chat that we had, you mentioned something about you don't mind looking for rougher types of equity curves, and perhaps not selecting the smoothest. And Marco has kindly offered to send you some rough equity aligned strategies if you want some.
Well, they still have to be performing well. They still have to perform well. But the rough equity line is I'm going to be doing. Somebody made a comment about it, and I'll probably be trying to do a blog post or doing some research on that to see how true my statement is.
Yeah. Okay. Cool. All right. Thanks for that, Marco, too, for offering that. Okay. Let's move on. We've got a couple of questions about metrics as well. From Tony, which metrics do you use to assess your indicators, parameters, period, and threshold?
So my main metrics that I use are compound annual growth rate, top 5 drawdowns, top 5 draw lengths. Those are the primary metrics I look at. I don't look at something like Sharpe ratio or Sortino's, any of those others. I also look at the yearly returns. I don't want to see 1 year dominating everything else, because sometimes you'll have a strategy that you test that makes all its money in 2008 and 2009. And it's done, but basically, doesn't made it anywhere else.
Yeah.
So, it might be great if that's the strategy is meant to make money during, volatile bear market, that's fine. But if it's not, you may reconsider it. So that's what I look at. Those are the metrics I focus on.
Yep. And how do you actually assess the robustness of a strategy?
That is a art as much as a science. The way I do it two ways. One is through parameter sensitivity testing, both in sample and out of sample. So I'll do, that's the main way I do it, is just, seeing how sensitive am I to the parameters, both in the in sample and out of sample.
A question here from Maurice, which you kind of already answered a little bit already. What sort of system stats do you look at, which you've just mentioned? But what are your minimum values to determine whether a strategy is worth trading?
Actually, that's a good question. Everybody's always looking for the maximum values. Everybody wants big bang for the buck. So for my compound annual growth rate over the last 10 years, so if I was making it doesn't matter the strategy. Over the last 10 years, I'm looking at, at bare minimum, 15 to 18% annual returns. Below that, it's just not worth it. I might as well just do some sort of simple index trading strategy. But it also depends on the strategy. So if I'm trading lower volume stocks, then I expect much more than that 15 to 18. At that point, I'm expecting 25 to 30. But if I'm trading ETFs or S&P 100, 500 stocks, then that 15 to 18 minimum is where I have. As for drawdowns, I don't like seeing drawdowns. I know under 15%, and I don't like seeing them over 35%. I kind of somewhere in that range, preferably in the mid 20s is where I like to see mid to higher 20s.
Okay, excellent. Thanks for sharing that. We've got a couple more questions here from Evan. How do you I've asked that one. How do you monitor your live results versus your research? And what do you look at when you're trying to decide if a strategy is actually performing as expected?
The one thing, of course, is every quarter I'll compare my what trades I executed versus what my backtested I've executed over the last quarter. A, to make sure I'm not missing any trades that my backtest says I should be. And B, also to compare, how much slippage am I getting? Am I getting, a lot of, negative slippage? Very rarely do I get positive slippage. That happens every now and then, but mostly it's, how much negative slippage am I getting? So that's one thing I do. As to, is my strategy broken or not working well? That tends to be, every year I'll kind of take a look at the strategy, take a look at the market conditions, and kind of make I want to say a gut call. It's like, okay, given this market conditions we've had over the last year, did this strategy perform as well as I would expect it? Just because the strategy did poorly does not mean it didn't have a good year. So this year, my mean reversion strategies, I'm not expecting them to have great years because volatility mostly has been low, and they need the volatility. But my breakout strategy at the end of the year, I expect to do well because it's the type of volatile market it is. So those are the kind of things I look at. As for knowing for sure a strategy is broken, you can't. You can't know for sure that, because it's had a bad year or 2 years, the strategy's broken, it's never going to work again. No, I've had strategies where I've said that, done that, looked at them a couple of years later, and it's like, oh my goodness, I should have kept trading it. So there's the only way to know for sure is 5 years later and looking back. By then you don't know. Too late to do anything really about it.
Yeah. What are some of the unintended effects that have crept in the past when moving from production to live, and how did you address these issues when you spotted them?
The biggest unintended effects were, I would say, has been very subtle bugs in my back testing, where the last one I can remember was I was not getting correct signals if the stock closed 2 days in a row at the same unchanged. So it was a very subtle bug in my code that had very minimal impact in my results. But at the end of the day, it took about a year of trading before I realized, wait a second, there's a bug. I'm not exactly getting the same trades as my backtesting is saying. So that tends to be what I've seen, is what I find these very subtle bugs that don't have any significant impact on the results, but are bugs nonetheless.
Yeah. Okay. Another question from Evan. What are your thoughts on exposure limits to single strategies or to mean reversion strategies as a whole from a capital preservation point of view?
Yeah, I mean, definitely think you should, I think everybody should be trading multiple strategies. And by multiple, I mean probably at least 4 different strategies, and not all mean reversion strategies. Because like you said, strategies come and go when they work well in different markets. And, you definitely need to do some limiting of that and understand the correlation between your strategies. For my personal trading, I have, what do I want to say? I want to say like 35%, maybe 40%. I don't have the exact numbers, but about between 30 and 40% of my trading account is in mean reversion strategies. I trade 5 different strategies and, try to move the money between them.
Okay, and a question about trade sizes. How do you set your trade sizes such that you are taking sufficient exposure in stocks, but are not overexposed in the rare cases that there is a market panic?
That is a hard one. That one's every individual needs to assess that differently, because everybody has different risk tolerances of how much they can afford to risk. So that is purely one of the things I do decide, how much money goes to any strategy is saying, okay, if the strategy were to have a drawdown twice as bad as my worst back-tested drawdown, could I handle it? If the answer is no, then the answer is I'm probably trading too much on that strategy. So that's how I personally do it.
Okay. And we've got 2 final questions here from Rob. The first one is, how do you feel about using a 4-to-1 leverage in a market on close system? Rob had to use this leverage in order to get selection bias down to a reasonable level, but he's worried in the back of his mind about a 1987 20% down or more day, which could wipe out the account.
Forget 1987. Take the flash crash, and that would have wiped you out too. So I think it's suicidal. Using the full leverage is you're going to blow out. I can just tell you that. All you need is one of these, another flash crash, and you'll get fully loaded and something like that. So fine, go 2-to-1 maybe, but understand that you just need to be really careful. And one way to deal with something like this is always be taking money out of the market. So if you do blow up, you've gotten money. You haven't lost everything. And you have this money that you've taken out that, what I call in case you blow up fund. So if you blow up, you can start back funds that, you took out of the market, and hopefully you take out enough money out of the market before you do blow up. So it's okay. But, you're playing with fire.
All right. Well, that ends all the questions. That was quite a lot there. We had 5 pages of questions. So thanks to everyone for submitting those. We learned a lot from Cesar today from answering those. And thanks, Cesar, for answering those questions.
Yeah, no problem. And if I didn't get to your question or didn't answer properly, please go over to my website and, fill in my contact form. I will definitely get to you right away and answer any and all questions.
Yep, cool. All right. Well, thank you very much for that. Cheers.
Bye.
Okay, well, that's it for this episode. Thanks for listening. I hope you enjoyed the show. Come on over to bettersystemtrader.com. That's where you'll find all the previous episodes, all the transcribes, all the show notes, and all the free weekly trading tips. bettersystemtrader.com.